so much. Thank you everyone for joining us this afternoon. As Katie mentioned, this is Alternative Structures, PO Financing, Factoring, and MCAs. And this is episode 5, which is our last episode of the Business Borrowing Basics series. You can read more about financial poise on slide 59 and slides 7 through 10, summarize the series and provide a list of all of the episodes in the Business Borrowing Basics series if you've not been able to listen to all of them so far. I have the pleasure today of being your moderator. My name is Jacqueline Brooks, and I am a corporate partner at Duane Morris. Let me introduce to you now our great panelists that we have here today. We have Harvey Gross, the founder and president of HSG Services, Inc., and the executive director of the New York Institute of Credit. We also have Tom Stamborski, a principal with Liquid Capital. Unfortunately, our third panelist was unable to join us today due to power outages from the massive weather in the Midwest, but thankfully he is okay, and we will carry on. We understand that you are not here for infomercials on each of the panelists, but you can find more information about each of them, as well as myself on slides 53 through 56. Speaking of the slides, in this webinar, we will not step through the PowerPoint slides in order, nor will you have to listen to us read any of the slides. This webinar, like all Financial Poise webinars, will be a conversation. But you should definitely keep the PowerPoints handy as a reference. And as we have our conversation, I will definitely point to some of them that may be in the areas in which we are talking about. Financial Poise webinars are supported in part by sponsors. For this webinar, the sponsors are Mood, the nation's premier online retail cannabis dispensary, Sunburst Digital, maker of Type to Learn, the #1 typing app for children K through 12, and Max Asset. If you need to conduct an online auction, Max Asset is your turnkey solution. You can find more information about these sponsors on slides 3 and 4. If you are attending the live webinar today with us, you can submit your questions using your web portal. If you are watching this on demand or have questions after the webinar, you can send an email to info@financialpoise.com. Just include your question, the name of the webinar, and then the episode, and we will do our best to get an answer to you as well. We repeat this information on slide 51. And, as I mentioned, let me go to one of the slides, slide 5, which is the disclaimer. And as slide 5 states, the PowerPoint and the conversation that we are about to have are meant for general informational purposes only, and not for you to act on without appropriate advice. What needs to happen in your situation, under your circumstances, are something that you should get advice from. We are not your lawyers, accountants, bankers, or other advisors, and encourage you to consult with them to determine what may be best for you, your business, and your particular circumstances. So with all of that, that is all of the intro. Let's get ready to dive in. So in this series, we've had a lot of fun of talking about, potential businesses that may be entering into different transactions. And for this webinar, let's talk about Jesse. And so Jesse is a successful fashion designer who started his own design and manufacturing business several years ago. Neiman Marcus wants to purchase an entire fall clothing line and is about to issue a $500,000 purchase order. Let's say that Jesse has roughly $300,000 that he needs to fulfill the purchase order, but that is absolutely all of the cash that he has. He can deliver the fall clothing line to Neiman Marcus in about 60 days, but he won't get paid by Neiman Marcus for at least 90 days after they are delivered. So during that period of time, about 150 days, he will need cash, or he will not be able to keep his employees because he won't be able to pay them. And he will not be able to produce more clothing for other customers. So Tom, what would be Jesse's choices here to try to solve this situation?
Well, I think for the moment, let's assume that traditional bank financing may not be available. In the absence of traditional financing, I mean, he needs to look at alternative finance to address both the supplier side and the receivable side. And that takes us into the area of factoring and the PO financing as well on the supplier side. It's a kind of a classic situation. A business owner tries very hard to procure a substantial order, let's say from a major retailer, in this instance, Neiman Marcus, and that's kind of the good news. But the more challenging news, as you just outlined in the overview, is that he has to pay the supplier, and I don't know the terms of the supplier, but let's assume that they want to be paid at the time that they ship the product. And that takes a substantial amount of the capital, pretty much all the capital that Jesse has right now. And then he has the other side of the equation, that if he can deliver the product, rather than having cash flow immediately available, or having the wherewithal to continue to operate while he waits to get paid by Neiman Marcus, he has the compounding problem of waiting 60 days for that invoice to be paid. So it would appear this is, again, a fairly classic situation. It's the good news, bad news type of situation. And in this particular instance, the combination of purchase order financing and factoring will allow Jesse to be able to pay for the goods and then be able to have working capital by factoring the related invoices. So he has, immediate access to cash flow.
Okay. So what exactly is a factor? Like, how would they sort of enter
Well,
into
before you get into the factoring, if you're going to do it in a time sequence, as Tom pointed out, purchase order finance is the opportunity to finance the order. In this particular case, the purchase order is what you would raise the question on. Will he be able to get that availability? Since he's not going to get open credit from the vendors, because if he does, that's a form of him being able to get the goods. Credit becomes an issue, open credit. So we're going on the pretense that he can't get open credit and he needs some sort of financing to handle that order. So the purchase order finance company, who normally does this, will look at several things to see if this order is financeable. One, has he dealt with this vendor before? And is there a history with the vendor so that they could fall back and say, yes, that's a successful history? If there's not, then they also look at that vendor to see if that vendor is in business a while and has a good history. Many times you'll find out the vendor he selected or she selects might not be a viable source, and the purchase order finance might not want to go that route. Those are all things that a professional PO finance company looks at. The other thing, in looking at the performance issue of it, they're also going to look at the expense issue of it. Are they paying too much for the goods? And what is as Tom pointed out, what are the terms and the lead time to produce? Because if you're going to enter into PO financing, you have to make sure that the lead time is successful enough that they could get those goods, turn them around, and produce it to an end user who's going to take those goods on a timely basis. So those are all things that the PO finance house has to look at. Also, they will not give the money to the borrower direct. They will make either a guarantee or cash available to the vendor, so satisfying them putting goods into work. All of that is a process, and it's a very important process. And in this case, is a solution process for Jesse to get the goods prepared. That's the PO financing side of it. Once that's accomplished, the PO finance guy has to also concern himself with who's going to be the receivable takeout when a receivable is created. If the PO finance company does not do factoring, which is the purchase of the accounts receivable, then they have to find a suitable PO factoring company to handle that side of it. In some cases, the PO finance company is a factor themselves, and in some case they're not. They have to get into a third-party relationship with an intercreditor agreement, and that enters into a factor coming in to buy the AR when that happens. So I hope they walked it through in some degree for you.
Definitely. And so, and this can go to you, Tom, or Harvey. For PO financing, would it typically be this particular type of situation? What are other like businesses that would commonly use PO financing?
Well, let me jump in here for a second. So classically, you have a situation where we have a company that is sourcing a finished product of many different varieties. Okay, as far as that's a finished product from a third-party manufacturer, supplier, whether it be foreign or domestic. So this could be certainly the apparel business. It could be just a whole scope of products, if you will, that are produced by a third party, where they don't really produce it internally. They don't really do anything in the manufacturing area. Typically, it is directly shipped from the manufacturer to the customer. So, I mean, the goods, again, just to touch on your question, it can be any number of things. It could be hardware, it could be toys, it could be apparel, it could be any number of equipment, it could be medical. We certainly saw a lot of this with PPP during COVID. So there any number of people that are in the quote unquote distribution business could use PO financing, especially when they have challenges in being able to finance those goods through their own means or without the availability of traditional financing.
And in addition to what Tom just said, which he said everything correctly, one of the big keys you mentioned, the customer was Neiman Marcus. And today, Neiman Marcus still remains a strong customer. If it was a problem customer that didn't have credit availability, that would change the minds of the PO funder, because he's not so comfortable that even though the goods come in and they might be good, the customer that's going to be the receivable might not be a good receivable. And a factor might not want to purchase it for a credit risk. That becomes a big problem as well. So in this case, you've served the purpose with Neiman Marcus being a good customer. If it was a bad customer, we'd have a different example that we'd have to be using.
And do you find that companies, it's like we started talking about sort of maybe traditional lending or on the open market, do you find that companies may use both traditional financing as well as some of these alternative structures like PO financing in their business?
So I would say that in the traditional sense, and as Tom pointed out, in the apparel textile industry, it's been for a lot of years the way to go. Factors can't or don't want to handle the inventory side of it and the PO side of it. So third parties have come in and made an industry in this. And because remember, years ago, everything was done with letters of credit. And that was the way it went. Today, we've been able to do alternative finance to take away that letter of credit, though some letters of credit are used for the purchase of these goods. So in the apparel textile, to say specific from this group, that is a way that normally business is done. Finding the right PO company and the right factoring company that will purchase that receivable, working together in a tri-party agreement. That is the success story. Now, many PO companies and factoring companies like to work together. They have history with each other. They understand each other's way of doing business and the different documents that are needed. So that is an important issue. When you have a new PO company and a new factoring company and they got to find a way to facilitate this, it takes more time and sometimes doesn't always work successfully.
Jackie, let me jump in for a second here, because you raised an issue which I'm very familiar with, because I've worked with banks for well over 30 years. I'm approached by banks, with some regularity, where they have a customer that has a scenario very similar to this. This one may be different. Jesse may not have the availability of traditional financing, but to answer or address your comment, if I'm approached by a banker who said, I've got a good customer, but they've got, they're getting inventory on the water from China, whatever the case may be, we're not inclined to do purchase order financing for a variety of reasons. In many instances, we've been able to carve out that transaction where they still maintain the relationship with the bank, but we will carve out that actual PO transaction and the related factoring of the invoice to accommodate that customer on kind of a targeted basis, whereby they still maintain a relationship with their bank. So it can go both ways, where they have a banking facility, and this is again kind of a specialized transaction, or it may be for the newer company that doesn't have that traditional financing available. So I see both sides of that.
That's great. And I think, Harvey, you had mentioned some of the things that the PO financing company may be looking for when they're doing sort of due diligence. What would be the time frame for a party to sort of go from beginning to end to get a PO finance?
The important time frame with a purchase order finance is going to be the lead time and how long it's going to take the vendor to produce the goods, that they're going to be able to produce the goods in time with the contract that they have with the end user. Because if it's taking them too long to get the goods done, that could create a problem for the borrower, because he can't meet the delivery. It's a problem. We had that for years with supply chain with COVID, that people weren't able to produce goods in time, and goods sat in warehouses and on boats and everything, and it was just a real mess. I'm knock on wood, I think we're back to being traditional again, hopefully, and we won't have those issues, but it woke up a lot of people that it's just not as easy as it used to be. And that's why you have to be very careful in dealing with the vendors that you deal with, whether they're overseas or not, that you know how they operate, they can fulfill the document that's needed, which is to get the goods properly made in a timely fashion, and without having any issue for returns or allowances or other type of problems with that. Now, the other thing that's important, many times when you're a PO finance company and you're going to interact with a factoring company, and you're going to have the factoring company buy the receivable, as Tom mentioned, if there's a bank involved, is the bank given a carve out and allowing the collateral to be used for this, such as the AR and the inventory? If the bank has those collaterals for whatever reason, they're going to have to subordinate in some way to allow the PO and the factor to work together. Now, another thing that happens, let's say there was no bank involved, and now this is going to be a new vehicle, so to speak, for the PO company and the factoring company to work with Jesse. Are they going to ask Jesse for a personal guarantee? If they're going to ask him for a personal guarantee, who gets the personal guarantee, and do they share in that personal guarantee between the PO company and the factor? That becomes an issue also. So along the lines of personal guarantees, there's 3 types of personal guarantees. There's an unlimited personal guarantee, which means he's personally on the hook for everything. A limited personal guarantee, he's only limited to a certain amount that's carved out. Or the third thing, which has become an issue in the last few years, called the validity guarantee, that some financial institutions will be okay with, indicating as long as the guy admits he won't pull a fraud and he's willing to say, I'll only give you good stuff, that's a validity guarantee. That is something that's been a new document over the last 10 or 20 years. But so those are important issues that come into play.
Very good. Good to know. I believe in some of the earlier episodes, we sort of take a little bit of a deeper dive into guarantees and some of those terms. So we've sort of been talking about factoring. So let's go back and Tom, if you could tell me a little bit more about how a company goes about applying for a factoring facility.
Well, the process of application and the creation of the file and all the components of the file are not terribly dissimilar from that which a bank would require. You know, whether it be financial statements, entity formation, receivables and payables, agings, you know, all the information regarding, you know, the the potential customer. Of course, in factoring, factoring really is, in contrast to bank, it's really leveraging a current asset, which is the receivable. So we're not talking about, a loan. The factor is taking legal assignment of that invoice for a creditworthy customer and leveraging that asset to be able to create cash flow for that client. But the file itself is very, very similar to that of a bank, with the exception that the factor will do a lot more due diligence and analysis of the creditworthiness of the customer, because that is a pivotal issue relative to feeling comfortable that you have a reasonable chance of being repaid. So whereas a bank will look at a receivables aging and probably give you some availability for things that are less than 90 days age, with a factoring arrangement, we're going to really look at each and every customer and be able to approve them for a specific level of credit, so we know where we are from a risk point of view and how much we could afford to finance, if you will. So that process follows a very similar process. Again, more analysis on the customer side, and of course, really the monitoring of those receivables that have been factored, through the processing of the transaction and the collection of that particular invoice. So again, it's not a great departure from a normal financing transaction, but the customer creditworthiness is a pivotal issue around which everything else kind of circulates, if you will.
So I'd like to jump in at this time. There are several factoring agreements that are used traditionally in today's world. And Tom touched base on it. The value of that customer is the importance of that accounts receivable and the collateral. If that is a good receivable because the customer is good, that's a very strong point for the borrower because of that. That being said, there are two types of factoring arrangements that apply to that. One is called a non-recourse, where the factor actually buys the customer risk, and therefore they are given the borrower the ability to customer to pay is what they're guaranteeing. On a recourse basis, they're not. So although the factor might want to still lend the money on a purchase, he's purchasing, he's not lending, he's purchasing that receivable, even though he's not purchasing it for the customer risk, he's still purchasing, or he's purchasing it for the purpose of having that as collateral. And if for some reason that customer can't pay back because it's a problem customer, it is charged back to the client, the borrower. So a recourse and a non-recourse is very important. The other type of documents and a type of contracts, and Tom touched on it before, if there was a bank involved, and now you want to enter into this arrangement, you have what's called a spot arrangement, where it's not an all sales contract, and they're only doing from spot from time to time. And this arrangement would come under a spot arrangement. So therefore, the bank could still maintain their relationship with the borrower, but they could enter into this spot arrangement. Many factors want to have an all sales arrangement where they get all the sales. So there's the all sales arrangement, there's the recourse arrangement, non-recourse. Yep. The other one, which is very important, is called notification or non-notification. Most factors want to deal in a notification basis. That means notifying the customer the invoice has been sold to them. They have to pay the factor back. Majority of factoring arrangements are on a notification basis. However, there is a non-notification for whatever reason. The vendor doesn't want anybody to know that they're factoring those receivables, and therefore it's done on a non-notification basis. Most factors won't do it. That's the exception. So those are about the 5 major types of contracts that factors use.
Let me just add one thing in there. Certainly on a recourse basis, we've seen certainly for, I guess, a number of years, factors will also use credit insurance as kind of a backstop, typically in the 2 contingencies that that the debtor goes bankrupt or is dramatically paying or out of terms, what they call protracted payment. So in a recourse area, and I know through Liquid Capital, we use credit insurance quite frequently. It doesn't make you bulletproof, but in a recourse type of situation, it's another little bit of a safeguard against those contingencies, which can be helpful in certain circumstances.
And as Tom points out, that the credit insurance could enter into two ways. One, the factor actually purchases the insurance policy and is the beneficiary, or in another case, the borrower buys the insurance policy and makes the lender the beneficiary. So those are two different ways it could work.
Yeah.
And are those terms generally like negotiated with the companies? I guess
Usually what a credit insurance company does, many times they want all the sales. So they want to, the difference is an insurance company gets paid up front usually on what the annual purchases are going to be that they're going to guarantee, where a factor usually gets paid as you go. So that's a difference. Also, we know that insurance companies work with deductibles, and for the most part, factors do not work with deductibles.
And so if we're sort of going back to some of the things that you both have talked about, and sort of our fact pattern here with Jesse, Neiman Marcus is very credit worthy, but let's assume for this purposes, for whatever reason, Neiman Marcus has not paid the invoice. Would the factoring company then go after Jesse? Or would they go after Neiman Marcus?
So if it's on a non-recourse basis, the factor is not permitted to go after Jesse unless Neiman Marcus isn't paying the bill because of a dispute. That's different. It's not an inability of the customer to pay, but they don't want to pay because they got a problem with the goods. Now it does go back to Jesse. But what they normally do, most factoring companies, is they make an advance rate against the sale. It's not giving a guy 100%, it's giving him 80 to 90% or something like that. We could go into later what the advance rates usually are. And therefore, they're hedging their bet that they have a 10 or 20% cushion. If now a full invoice isn't being paid back, there could be an over advance position now worked out, because all of that credit balance is gone with the customer not paying. So what factors have done, if they have a viable client, they'll then give them less advance rate against future sales to different customers so they can get back into what's called formula. And so that's a constant thing that factors do with clients. If the client is a problem, that these disputes are across the board with many different customers, then the factor has a bigger problem. They can't get back into formula any time soon. Now you have a different type of problem. Then the question comes in, when do they go back to Jesse? When do they go back and say, Jesse, you got to put money into the business so that we can get more collateral here? Or they do go to him on a personal guarantee. Usually the personal guarantee is the last thing they do after they try to collect all the receivables that they can collect.
And it sounds to me, and I think, I'm not sure if it was you, Tom, or Harvey, that mentioned it, but the word collateral kept being mentioned. And so I think we should talk about what the factoring company may file in connection with the collateral that they.
I want to address that because it's a very important question that you ask. When a factor purchases receivables and they have inventory they might or might not finance, factors like to take liens on everything. They want to do all assets. And what we try to tell the borrower is you only want to put up a collateral on what you're going to get money against. So if the factor's not going to finance your inventory, you shouldn't be giving them an inventory lien. You can't always do that, but that's what you should try to do. So the word collateral really is the specific asset that's going to be used for the borrowing. Banks have done that. Asset-based lenders have done that. they identify in the agreement what they're gonna do as a percentage against which asset. For instance, a percentage of receivables, a percentage against inventory, percentage against equipment, or whatever, you know, the collateral is gonna be.
Yeah, and I've definitely been, I've worked on transactions where, we, you know, my client may be either the selling, client or the buying client, and, they have a factoring arrangement, and so we're seeking to have the arrangement, paid off and terminated. And the closing date may get changed. And so unlike traditional financing where there's sort of we know if it moves one day, what the payoff amount will be. I've seen it swing sometimes in factoring arrangements from one to the other. Tom, do you know why that might be?
I want to make sure I understand kind of the nature of your question there. I mean, you're talking about just timing issues. Let's say for a traditional financing transaction, again, we have a loan, we have this, that, or the other thing. So we have dates certain, and we know that if we go over that. So, well, I mean, at the end of the day, in factoring, it is a fee-based type of process, and it's based on time. Okay. So time notwithstanding, I mean, if we were supposed to be paid, and again, I don't know if I'm addressing this correctly, if we had something that was like a net 30 invoice, okay, if we go beyond 30 days, there will be additional fees that will accrue until those funds are collected, okay?
Right.
So it's a bit of a moving target because, you know, those fees will continue, you know, unless the structure is something where they have a kind of a drop dead date. But typically with factoring, until that invoice is collected, fees will continue to accrue. So that could be 1 day or 2 days, and based on the structure of the fee structure, we know how much that's going to be. You know, we can calculate almost on a daily basis what that fee accrual will be for not hitting, you know, that 30-day window. So I don't know if that addresses your question directly.
Well, Jackie, I'd like to jump into your question because Tom answered it correctly, but just to put it in sequence, the factor can't factor the receivables if they're not going to take a UCC filing. So that's an important issue. So the question comes in, when they take that UCC filing, then they do have collateral. They don't have collateral if they don't have a UCC filing. So it's important when the factor goes and does UCC searches that there's not somebody ahead of them. And that creates a problem. Sometimes borrowers don't even know they gave out a UCC and it never was terminated. And that's an issue. So that's a legal issue, and it's very important. But it's very important that that UCC is filed properly and that it's effective and it's filed in the proper state. And there are so many different issues that go into that. I know later you're going to talk about MCAs. That becomes a big problem because they don't believe in the UCC world. And that's one of the things we'll talk about.
Yes, no, that's correct. And Tom, you did answer the question, because you're correct with traditional financing, traditional loan, you know, they're sort of the interest rate and you're able to understand what the interest rate will be. But in connection with factoring and based on the timing of the receivables and when the factoring company receives them, it can swing.
So I think the important issue on this conversation today is that everybody who's on this Zoom knows factors purchase accounts receivable. It's a purchase. It's not a loan. When an ABL or an MCA, whoever it is, and they give money, they're doing it as a loan. There's a difference between a purchase and a loan. And factoring is a purchase. Now, there's a gray area if they purchase it on a recourse. Are they really purchasing it on a true sale type of thing? And that's a legal question for a different day. But that is something that people have to at least have an idea about.
Very true. And so between factoring and PO financing, what would you say are some of the advantages or disadvantages of them? You know,
Well,
versus
the big advantage in a PO financing / factoring, it gives the ability to the borrower to not only finance the order, but also get his receivable collateralized and get advance against. Because as you mentioned in your early part of the day, there could be lead time to get the goods made, but then the customer isn't paying for terms of 30, 60, 90, whatever it might be. Can they exhaust that cash flow and not get paid? So the factor serves that purpose on a receivable. So a good PO finance / factoring arrangement in a tri-party agreement could really benefit the borrower. And it'll do several things for them. The cash flow for sure, the availability to get the goods and to satisfy their deal with the customer. Also, the good PO finance company verifies that's a good vendor, an honest vendor, a real vendor, and makes that vendor really pay attention to detail. There are times the vendor could now hold hostage to the borrower if they get too much money up front and then they don't produce the goods. And that puts you in a limbo. So most PO finance houses know how to work away on that trade supply issue. And the factor obviously knows the best way how to collect receivables and handle a receivable for the benefit of a client.
One thing that I think is important too, I mean, all of that is absolutely correct. In those instances where we have somebody like Jesse, this may be his first order with Neiman Marcus, okay? And depending upon how he negotiates the deal with Neiman Marcus, as Harvey pointed out earlier, you're going to have time frames that have to be met for production, shipping, and delivery. To the extent that all these things come together, they deliver a quality product that's acceptable to let's say Neiman Marcus in this instance. It can make a huge difference in their business, because typically with PO financing, you're demonstrating capacity to fill that order, which sometimes will lead you to the next order and the order after that, especially if there's a good sell-through. So besides just the financial benefits, which are sizable, both on the good side and on the invoice, you're able to demonstrate capacity, and in many instances, it can take a smaller company and elevate their position within the industry up to maybe a higher tier within the industry, because now they're playing with the big boys. Okay. And that's a significant benefit if everything works out correctly.
And what Tom pointed out is very important. So, and this has happened in the past where a lot of the big retailers have told their vendors, we would like you to have these goods made in this particular place. And therefore, you're putting them in a better environment. How Jesse found that respective vendor is a good question, which any trusted advisor would like to ask him.
Yeah, it makes sense. And if he's getting orders from Neiman Marcus, I'm sure orders from the competitors of Neiman Marcus will be around around the corner.
So the important issue will be, which comes to play when you deal with the retailers, is gross profit. And is there enough meat on the bone on that order? Because there are many times in order to get the order, you work thin, right? And that's a problem, especially when retailers make chargebacks.
And is there a sort of profit margin that they would be looking for?
Well, that's a good question. Some of the big retailers over the years have established what they call a guaranteed gross profit. And they tell the manufacturer, this is the gross profit I want regardless. So in the apparel business, gross profits usually run between 10 and 30%, depending on what you can get by. There were some industries like bridal gowns and other types have bigger gross profits because of the size of the volume and the specialty of the goods. So different industries have different type of, if you're dealing with t-shirts, you're dealing with a lower gross profit because you're spinning more without much value that you're putting in. So gross profit is a very important issue. And if you're in the apparel textile industries, for sure, you should know what gross profits people are operating with. And and most factors in PO finance houses know that. And they'll be able to look into these contracts and see what's worthy and what's not.
And I have to imagine that gross profit is also affected by sort of brand recognition and
Yes,
value.
that's correct.
So, you know, the more high end, probably more profit margin there is there for some things, especially in the textile industry.
Now, before we leave, because eventually you want to talk, unfortunately, you want to talk about MCAs. A big thing that has happened recently is e-commerce, with Amazon coming in and buying a lot of the orders that normally went through the normal retail chains in so many industries, right? And Amazon became the new place people went to. So it wasn't the receivable that was questionable, it was the inventory that lenders had to work with. But that is going to be a problem someday too, because now Amazon wants to go like the big retailers into the chargeback world, where they want to not pay the 100 cents on the dollar. So that's a work in process story right now. Anybody that's listening to this, realize it's the beginning of an issue that might be go away, or it might become a big problem. We're still all looking at that right now as we speak.
Interesting. And I think before we talk more about sort of MCAs, Tom, in this market, where, you know, businesses are looking at, I know traditional lending, interest rates are higher. Would you say seeking sort of factoring or PO financing, is it cheaper, or would it be more expensive from a cost model for those businesses?
Well, I think it's a general statement, even though, you know, banks are at a little bit higher rates that they're charging right now. Clearly, and again, I'm not going to speak for each factoring company and what they're charging, but generally speaking, it's going to be more expensive than traditional financing. So, you know, that's part of the discussion with a business owner, to really understand their situation, to understand what the opportunities are, and what this means to them. Okay, we talked about margins, and you know, not to sound trite here, but if you can't have a structure that allows you to take and fulfill that order, your margin is zero. Okay, so I try to be very, very clear with any company. This is not bank financing. I do a lot of hypothetical transactions to show them what that cost structure would look like, and then they have to make a business decision. If it allows you to get the order, even at maybe a lower margin, if it allows you sometimes to keep the doors open, they have to assess the value of that. And very frankly, I think once they go through that analysis, and again, having that honest conversation that, again, this is more expensive than bank financing, but what is the bottom line to that business? You know, you pay a little bit more, but it gives you the opportunity to grow, and to be able to elevate within your industry. So again, that's part of the discussion. It's some of the analytics you have to go through. But to answer your question, you know, in more circuitous way, it is more expensive than bank financing, but the opportunity, the benefits may far outweigh that in the overall scheme of things.
So in a factoring world, they don't think they're that expensive, and they try to be competitive. But the truth be told, what somebody should be speaking to the borrower about, will the factoring operation save them money? Will it save them having collection costs and other type of expenses, bookkeeping and others that the factor could save them on? So what factors have built up is service charges that will benefit the borrower. So that being said, it's not just the use of money. So for instance, in the factoring world, the bigger factors offer their rates in two ways. One, a specific use of money. That's what you pay for the money. And then two, what you pay for service. For instance, is there credit checking involved, collections, bookkeeping, and everything else. And that's the service end of it. And those are two different rates. Most of the smaller factors, they blend the rate. It's one rate, as Tom points out. So that's the one rate. And it's competitive. It's usually based on the size of the client and the quality. So the usual answer is the more volume you do, the less you're going to pay on a percentage basis. And the smaller volume you have, the higher you're going to pay. That's the way the world has always been. And that's how that works. But I will tell you, from an accounts payable standpoint, many retailers like the fact when somebody is factored because they know how to make the payables. It's just another plug-in, and it's easier for them in the accounts payable.
No. All right, so Harvey, what are merchant cash advances or MCAs?
So the MCAs, to give a little background on the MCAs, back in the 1990s, they were called credit card processing companies. And what they did in certain industries where vendors were taking credit cards, they would, whether restaurants, beauty parlors, and that's how the industry started with that. The credit card processor would charge a certain amount of money to process the credit cards, but they created a financing level where they would also, in addition to the credit card purchasing, give them money. And they gave money, usually it worked up to 6 months worth of sales. So if they did 100,000 a month previously, they might give them a 600,000 advance along with processing the credit card. So it was two fees put into one big number, which did the credit card processing and the use of money, which was the advance money they were getting on future sales. A lot of vendors thought that was very convenient. By the time 2008 rolled around and the world hit a problem, the credit card processing slowed down substantially, and the MCAs came in and they did ACH swipes. So they weren't only doing credit card processing, they were doing credit card and a bank swiping of the balances. And that's how they came in to be merchant cash advance, taking these ACH swipes. Using a similar formula, will give you money up to 6 months in advance, whatever it is. The interest rates were anywhere between 40 and 120%. So it was very hefty. They didn't worry about usury, even though they should have. And people found the way of getting the money easier because alternative finance, you had to go through different things, as Tom mentioned before, financials you had to produce and other types of things. So a lot of borrowers felt, well, this is an easy way for me to get money. And they didn't really zero in on how much it was costing them. And that's how the merchant cash advance got involved. In addition to that, they didn't just make this a fertile market for them, giving money out quickly and very timely, in that they didn't go through the financial wherewithal of waiting for financial statements and other ways of credentials. They just gave the money out. So borrowers felt that to be comfortable. The problem we had with merchant cash advance is, in order for them to get to these borrowers, there was a phenomenon called ISOs, independent selling organizations, which were brokers across the country that fostered these sales. And they went out and were very aggressive, and they found these borrowers to say, I can get your money, here it is. And they accomplished the deal. They didn't do any vetting out to see whether the guy deserved the money or not. They just got the money done. The deal got closed. Then they didn't stop there. Then they went to a second, third, and fourth, and fifth source, and they called it MCA stacking. And they got the guy 2, 3, 5 times as much as he needed or wanted, but they got it for him. And that has created a big dilemma in the market today. So between the MCAs not working within regular pricing that should be, working on no intercreditor agreements, no UCCs, and all of these things, it was really bad for a lot of years. In addition to that, they had what was called confessions of judgment, where in their agreement, now in the old days, factors had confessions of judgment, but it would only be, I will take the keys when you're insolvent, and therefore that's when I'll take your business over. They didn't have that in the MCAs. They were able to take advantage of the guy's keys anytime they wanted based on the agreement that they had. And that became a problem. In some states, that's been eliminated. New York eliminated it. Some other states trying to eliminate it. So between the high interest rates, the MCA stacking, the no intercreditor agreements or UCC filings, confessions of judgment, and everything else, they became a real problem in the marketplace, and it became a real big problem. And until COVID, the MCAs ran away with the world. The governments helped out during a few years of COVID where they made easy money for borrowers. But we know that's gone now. So the MCAs are being looked at by the feds and states in many states because of all of their business tactics. And what happened in a lot of states, they've had what's disclosure laws that now lenders have to advise the borrower what it's going to cost them to deal with them. And these disclosure laws, which are in different states, it's not federal, it's statewide, have become an issue. They went after the MCAs with these disclosure laws, but they caught the factors and the ABLs in the middle of this. So we're all involved today knowing what MCAs do, even though we don't want to deal with MCAs. There are times a good MCA, and there are a few of them, could come in and help out a borrower at a time when they're having trouble getting alternative finance. Even alternative finances have brought in MCAs to help with that issue. But it's really the minority of the situation.
So, based on that, it sounds like, there's less diligence, less information that the borrower or the business will be giving to the MCA company. But because of that, it also sounds like it means that they can get the cash faster. And so it seems one of the biggest issues has been ensuring that the business actually understands what the cost of that money is. And I think based on what you're saying and what I've seen, a lot of the state legislatures have definitely tried to sort of require that to be disclosed so that, sort of going back to what you were saying, Tom, they can understand whether it's an opportunity they want to take or not based on sort of what's going on with their business, right?
Well,
Lots of funds
it's
is
driven by,
important, yes.
it's driven by a lot of emotion. If somebody does not have other resources to go to, and as Harvey pointed out, it seems almost too good to be true. They either don't want to go through the process, they're concerned about being involved with the process, but somebody can give them a substantial amount of money, and they do that more of a knee-jerk reaction. That's where it puts that company in peril.
Mm-hmm.
And then it becomes there's a compounding effect that Harvey pointed out is because of the strain it puts on the business. Now they need more money, so they'll have one or two or three. I've talked to companies that had 5 MCAs simultaneously, and it's the death knell of that business.
Definitely.
Harvey's right. There's a few MCAs that actually have pretty good disclosure. They really go a bit through a more analytical process. And although I'm not a big fan, my position is, if you can really ferret out all the aspects, if you can put this in the context of a business strategy, and you can figure a way to get out as quickly as possible, satisfying a very specific need, it may be an interim move that you might want to consider. But most people don't go that route. Okay, they just do it because it's easy, and the interest rates are very, very high. They're taking daily or weekly debits, the ACH swipes, and it's a problem for a factor. Depending upon how that is structured, it can really muddy the waters for a factor trying to go in there and work with them as well. So there's a lot of issues to contend with.
So what Tom said very correctly, and most borrowers don't know this, but if they have a factoring arrangement, they're not permitted to go outside of that lending arrangement unless the factor is okay with an intercreditor agreement. MCAs don't do that. They just go and they just give the money and they take money, and the factor has the right to put the client into default. And some of the factors have said, if you're going to use an MCA, you've defaulted, I have the right to charge you more. And it compounds the issue even more. So that's why we all have to be aware of the borrower's rights and be respectful. And most of the time, we hope that the borrower has some sort of trusted advisor, a consultant, a lawyer, an accountant, somebody to give them some idea of why you shouldn't be just going out there willy-nilly and borrowing money just because it's thrown on the table. I would tell you myself, almost every 30 minutes, I'm getting a phone call from somebody saying, do you need financing? And they're not factoring in alternative finance people. They're all these ISOs and MCAs.
And it sounds like for, especially in the marketplace, for companies that are seeking to, that are acquirers, MCAs could be an issue if they're not filing UCC ones or doing anything to let the companies know what's there. So diligence on those businesses would be highly important, especially if they have confessions of judgments and things in place where they can step in whenever they want to.
So New York State, the Attorney General did a major lawsuit against the biggest MCA companies. And now that is going to be the benchmark that everybody's going to be looking at. And they're not saying it's RICO yet because of the problem, but they are saying that they're not doing traditional financing, right? So what comes back, we talked about it before, factors purchase receivables. Technically, when you purchase an asset, you're not under a usury in the respective states that you're in. When you have a loan, you are in the respective state, you're subject to usury. Different states have different rules. Some states don't even have usury laws, believe it or not. So that's where the disconnect is. And we all have to be mindful of it. But the MCAs, it's really hurt a lot of people. They were temporary Band-Aids for people, but now they're paying the price. And especially if we're going to be going, hopefully, I'm knocking on wood, that America goes into more domestic production that we're going to try to do. We have to have alternative finance that's effective. And the alternative finance is going to take the place of banks, the feds, MCAs, and we have to, through PO and ABLs and factors, be in a position to do this type of financing. It's very important that the market knows about it and everybody pays attention to what we got to do.
Definitely. And I think for those looking at the slides, slide 48 through 50 provide a little bit more information on MCAs. But it sounds to me, based on everything sort of going on, whether it's in New York or California, California is also a state that's done a lot of regulation recently. You know, it's sort of stay tuned because there's been a lot of state regulation regarding disclosures that will definitely affect MCAs and affecting other lenders, all sorts of lenders. So Tom, do you have any sort of final remarks regarding alternative financing that you want to leave our viewers with regarding how they should think about it and when to think about it?
Yeah. Well, hopefully through this discussion, we've kind of made it clear that factoring, PO financing are very, very valuable alternative financing structures that can greatly benefit a company. Again, they need to understand all the elements. They need to do their due diligence. They need to really, as Harvey points out, maybe have somebody advising them on the other side. But in the area of challenges within businesses, depending upon industries, periods of time, as far as that's concerned, this type of financing can be very, very beneficial. It can be very strategic, and it can have a major positive effect on these companies for a variety of reasons. So it's something that I think is it's been around for a lot of years. It's going to be probably going on for a lot more years, and I think people should really take a look at it as needed to be able to accomplish those strategic financing goals for their companies.
And I think that last phrase you use of strategic financing goals of the company, it's really where it comes out, definitely.
So I'd like to just put my 2 cents in. Since I run a few associations, there's many good associations out there, and we represent the lenders, but we also educate the professionals, the lawyers, the accountants, the consultants, who are the trusted advisors. And we're all trying to come up with the best solution process, educating the lenders on ways to do best business practices, educating these professionals how to handle their clients in the best way. And that's what's needed here. It's a two-way street. And I think these type of seminars we're doing today really put forth the communication that's needed.
I think that's right. I think that's definitely right. And so with that, I want to thank both you, Harvey and Tom, for joining me. And that concludes this webinar. We encourage everyone to continue watching Financial Poise webinars and to join us or actually this is the last episode of the Business Borrowing Basics series. So if you've not had a chance to see the other series, definitely feel free to go back and look at the on demand. But thank you very much, Tom and Harvey, for your wonderful insights this afternoon. And with that, I wish everyone a great afternoon.
Thank
Thank you,
you.
Jackie.
Bye.
Take care.